Financial audit best practices for clean results in an era where financial transparency is paramount. Conducting thorough financial audits has become essential for businesses across industries. Whether you're managing a small enterprise or overseeing complex corporate operations, understanding how to perform effective audits ensures compliance, identifies risks, and builds stakeholder trust. A well-executed audit not only safeguards against fraud but also enhances operational efficiency by uncovering areas needing improvement. For accountants and finance professionals, mastering these best practices can make all the difference in delivering reliable results that meet regulatory standards and business objectives alike. The importance of financial audits in modern business operations. Financial audits serve as critical checkpoints in any organization's journey toward financial health and integrity. They provide an independent assessment of a company's financial records, ensuring accuracy and adherence to established accounting principles such as GAAP or IFRS. By verifying financial statements, auditors help detect discrepancies that could indicate errors or fraudulent activities. This verification process is vital because even minor inaccuracies can lead to significant consequences when scaled up over time. Moreover, audits play a pivotal role in maintaining investor confidence. Stakeholders rely heavily on audited reports before making investment decisions, knowing they reflect true performance rather than manipulated figures. Regulatory bodies mandate regular audits to enforce legal compliance and prevent unethical financial reporting. Non-compliance can result in severe penalties, including fines, loss of licenses, or reputational damage that might be difficult to recover from. Preparing for a successful financial audit process. Effective preparation sets the stage for a smooth audit experience. Organizations must ensure their internal controls are robust enough to withstand scrutiny while providing clear documentation paths for auditors to follow easily. This involves reviewing existing policies related to financial transactions, inventory management systems, payroll processes, and other key functions within the organization. Identifying potential weaknesses early allows corrective actions before external auditors arrive. Training employees involved in handling finances is equally crucial. When staff members understand what is expected during an audit, such as retaining receipts properly, they contribute significantly towards minimizing delays or issues later on. Setting realistic timelines helps manage expectations both internally and externally. Communicating deadlines clearly prevents misunderstandings regarding data availability or document submission requirements ahead of schedule. Establish strong internal controls. Implement checks and balances mechanisms at every level so that no single individual holds too much power over financial matters without oversight. Maintain accurate books. Ensure all entries made into ledgers match actual events accurately. Avoid using estimates unless justified under specific accounting rules. Document everything thoroughly. Keep copies of contracts, invoices, bank statements, etc., organized systematically for easy retrieval whenever needed. Prioritize communication. Encourage open dialogue between departments responsible for different aspects of finance so information flows freely among teams involved in preparing materials for review. Evaluating internal controls during the audit. An integral part of any financial audit revolves around evaluating internal control structures designed to protect assets and promote accountability. These evaluations assess whether current procedures effectively mitigate risks associated with misstatements or irregularities. Auditors examine segregation of duties, one common method used to reduce chances of fraud, to determine if roles have been appropriately divided amongst personnel who handle sensitive tasks like authorizing payments or recording them subsequently. They also look closely at authorization levels assigned to various individuals, ensuring those entrusted with approving expenditures possess adequate authority based upon predefined criteria set forth by management guidelines. Detailed reviews include analyzing access rights granted through software platforms utilized daily by finance staff members working remotely or on-site depending on organizational needs. Additionally, Auditors investigate how frequently reconciliations occur between accounts payable/receivable balances versus general ledger postings, since timely matching reduces exposure to unrecorded liabilities or receivables. Reviewing key financial statements for accuracy and completeness. One primary responsibility of auditors lies in scrutinizing core financial documents produced annually by organizations undergoing examination. These typically consist of balance sheets, income statements, cash flow analyses, and shareholder equity summaries. Beyond mere numerical validation, experts delve deeper into contextual factors influencing reported outcomes, such as changes in market conditions affecting revenue streams or unexpected costs arising due to unforeseen circumstances impacting net profits. Attention must be paid particularly towards footnotes appended after each statement, which often contain disclosures about contingent liabilities, pending litigation cases involving the entity, or commitments tied to future obligations yet unfunded currently. Cross-referencing supporting evidence becomes necessary here, for instance confirming asset valuations via third-party appraisals rather than relying solely upon subjective estimations provided initially by company representatives. Identifying potential fraud indicators through data analysis techniques. Modern auditing leverages advanced analytical tools capable of sifting vast amounts of transactional data, quickly identifying anomalies worth investigating further manually. Such techniques enable quicker detection compared to traditional manual methods alone. Data mining algorithms scan patterns across numerous datasets, looking out specifically for deviations from historical trends, suggesting possible manipulation attempts either intentionally done maliciously or accidentally caused through human error. Statistical sampling provides another powerful approach, allowing auditors select random subsets representing larger populations, thereby reducing workload significantly while still achieving high degrees of certainty regarding overall population characteristics. Machine learning models trained previously using known instances fraud help flag suspicious behaviors, automatically alerting relevant parties, promptly enabling swift intervention measures, preventing escalation situations potentially damaging reputation severely. Leverage technology wisely. Utilize specialized software solutions tailored explicitly towards detecting irregularities efficiently without overwhelming users trying to interpret raw outputs themselves blindly. Train team members adequately. Equip analysts interpreting findings generated by automated systems sufficient knowledge distinguishing genuine concerns flagged system versus false positives, resulting normal variations naturally occurring dataset. Ensure continuous updates. Regularly refine models incorporating latest developments emerging field, keeping pace evolving tactics employed perpetrators attempting conceal illicit activities successfully longer periods undetected. Balance automation with judgment calls. While machines excel pattern recognition capabilities, final determination whether issue warrants investigation remains firmly within domain expertise possessed certified professionals possessing requisite qualifications credentials. Ensuring compliance with regulatory standards and industry-specific requirements. Compliance forms cornerstone successful audit engagements, especially given stringent laws governing financial conduct globally. Understanding applicable regulations pertinent industry sector ensures seamless navigation. Hurdles posed. Non-adherence penalties imposed. Authorities enforcing mandates strictly. Organizations operating internationally face additional challenges complying diverse jurisdictions simultaneously requiring awareness. Local statutes alongside international treaties affecting cross-border dealings regularly conducted. Enterprises engaged global markets actively. Industry-specific guidelines may impose stricter controls necessitating bespoke approaches addressing unique demands. Particular sectors serving distinct clientele exhibiting differing risk profiles compared. Generalized frameworks applied universally. Engaging legal counsel. Familiar nuances. Regional legislatures proves invaluable guiding firms implement appropriate safeguards meeting minimum thresholds required respective countries' territories where operate physically virtually. Communicating findings effectively to management and relevant parties. Clear articulation. Discovered issues crucial facilitating informed decision-making concerning remediation efforts required. Address deficiencies identified. Course evaluation phase completed independently. Reports should highlight materiality judgments rendered, assessing significance, detected problems, relative size, impact, firm's operations, profitability, stability, long-term viability thereof, determined subject matter experts performing assessments objectively, presenting conclusions visually appealing manner, utilizing charts, graphs wherever beneficial, enhancing comprehension, complex subjects otherwise conveyed textually alone might confuse audiences, unfamiliar jargon, terminology commonly encountered. Professional settings. Encouraging feedback loops post-delivery promotes ongoing improvements, future cycles, reinforcing culture, continual enhancement, quality assurance initiatives undertaken consistently, maintain highest standards, achievable discipline continuously, advancing methodologies adopted practitioners worldwide. Continuous improvement strategies post-audit, implementation of corrective actions once initial audit concludes. Implementing recommended corrections, marks beginning next chapter, focused, sustaining gains achieved throughout engagement duration. Continuous monitoring mechanisms prove instrumental, tracking progress against targets, established improvement plans developed collaboratively, stakeholders invested, success outcome desired. Regular follow-up scheduled, periodically verify effectiveness, implemented fixes, ensuring they remain viable, adapting changing environments, dynamically influenced external forces beyond direct control, entities affected indirectly through ripple effects, cascading, entire ecosystems interconnected financially, digitally nowadays. Documentation serves dual purpose, acting record trail, proving compliance met, additionally reference point, revisiting past decisions, justifying rationale behind choices made, earlier stages project lifecycle, assisting retrospective analysis, identifying lessons learned, useful, informing strategies moving forward confidently. Investment made, upgrading infrastructure, technologies considered, prudent measure, strengthening defenses against vulnerabilities exploited, exploiters seeking gain, improperly manipulating figures presented publicly, private spheres respectively. Conclusion: mastering financial audits requires dedication, meticulousness, applying proven strategies consistently across varied scenarios, encountered practice. By focusing on foundational elements outlined above, from establishing solid internal controls right through communicating outcomes transparently, you position yourself favorably, navigating complexities inherent profession adeptly. Remember, always prioritize clarity, precision whenever documenting observations, drawing conclusions derived, rigorous examinations performed diligently according prescribed protocols, maintained vigilance throughout tenure, involvement projects entrusted, managing, overseeing accordingly. HTML